Benjamin Graham, often called the father of value investing, revolutionized how we think about the stock market. His masterpiece, The Intelligent Investor, is not just a book, it's a roadmap for navigating the often turbulent waters of investing. Graham believed in logic, analysis, and above all, patience. He taught that true investing is about owning a piece of a business, not just trading pieces of paper. Graham's approach was simple yet powerful. He argued that investors should focus on understanding the underlying value of a company, ignoring the short-term noise of the market. This long-term perspective, coupled with a disciplined approach, forms the cornerstone of his investment philosophy. Graham's teachings have influenced generations of investors, including Warren Buffett, who famously called The Intelligent Investor by far the best book ever written on investing. One of Graham's most important distinctions is between an investor and a speculator. He believed that understanding this difference is crucial for long-term success in the market. An investor, according to Graham, is someone who carefully analyzes businesses and buys stocks based on their intrinsic value. They are patient and disciplined, focusing on the long-term prospects of their investments. A speculator, on the other hand, is driven by short-term market fluctuations and rumors. They try to predict the market's ups and downs, hoping to make a quick profit. Graham cautioned against speculation, arguing that it is akin to gambling and rarely leads to sustainable returns. He believed that true investing is about partnering with great businesses and participating in their long-term growth.
To illustrate the irrationality of the market, Graham introduced the concept of Mr. Market. Imagine Mr. Market as an overly emotional business partner who offers you a different price for your shares every day. Some days, he's optimistic, offering a high price. Other days, he's pessimistic, offering a low price. Graham argued that investors should not be swayed by Mr. Market's mood swings. Instead, they should use his irrationality to their advantage. When Mr. Market is pessimistic, offering low prices, it's a good time to buy undervalued stocks. When he's overly optimistic, it might be time to sell. The key is to stay rational and not let Mr. Market dictate your investment decisions.
One of my most enduring concepts is the margin of safety. I argued that investors should never pay the full price for a stock, even if it seems like a great company. Instead, they should look for a margin of safety, buying the stock at a price significantly lower than its intrinsic value. This margin of safety provides a cushion against potential errors in your analysis or unforeseen circumstances that might negatively impact the company. I believed that the larger the margin of safety, the lower the risk of losing money on an investment. This principle is especially important in volatile markets, where prices can fluctuate significantly.
Graham recognized that not all investors are the same. He outlined two distinct investment approaches: defensive and enterprising. The defensive investor prioritizes safety and stability, seeking consistent but perhaps modest returns. We are risk-averse and prefer to invest in well-established companies with a proven track record.
The enterprising investor, on the other hand, is willing to take on more risk in pursuit of higher returns. We spend more time researching and analyzing companies, looking for undervalued opportunities.
Graham believed both approaches could be successful, but the key is to choose the path that aligns with your risk tolerance, investment goals, and time horizon.